Now in this video I just want to go over some entry points, the scalping entry points. Now we've actually got a lot of people on the course now. The vast majority are extremely happy. They're making money, we're receiving emails and people are delighted to be on the course and they're actually enjoying the course. But I wanted to clarify some of the entry points. Now the other videos will actually explain what I look for, but I want to try and create a simplified version of what you need to look for on the entry to your scalps. Now depending on which videos you've already watched, hopefully you're actually watching this, you've already watched some of the videos, you've installed Bet Angel Professional or Bet Angel Trader, you've read the majority of the information on this page, which I advise in the very first video. Now you're looking to actually do some scalping yourself, which is fantastic. On the very first how-to video we actually mention the make, market, scalp. Now this is fairly simple. Now I'm actually filming this late at night, so it gives an ideal example here. Now the make, market, scalp is what I advise you start with because it gives you a detailed analysis of how the market works. Now if you look on the micro chart, after you've clicked the one click, once you click the one click you'll come to this page, and this is what I call the make market page. Now the first thing you need to look for is the micro charts. Now you'll see a static line on all of these horses. That's because it's late at night and obviously nobody's trading late at night. If for example this was 30 minutes before the start of the race, then what you need to look for is ideally a static line. Now what a static line means is the liquidity on the back bet side and the liquidity on the lay bet side is fairly equal, and that's why the price is not rising and the price is not dropping. If more money was coming in on the back bet side or the lay bet side, then you'd see movement in the micro chart. As you can see on my cursor, there's no movement. It's a static line. Now this means that this is ideal. This is an ideal situation for a make, market, scalp. And the way you would do that is obviously click make market. And once you actually click make market, you'll place one trade on the back bet and one trade on the lay bet. And the idea is because it's a static line, the liquidity is being entered on the back bet and the lay bet pretty much equal measure. So when your trade and your scalp goes on the back bet and the lay bet, then it's going to gradually get eaten away. The market is going to reduce, and depending where your scalps are in the liquidity queue, your scalps will also get taken because the price is not rising, the price is not dropping. So because you've placed your money on these price points, it will get taken. It has to get taken because the price is not rising, it's not going anywhere. And that's the whole idea of a one tick profit on the make market. So the make market is ideally for a static line. So the price is not moving, so you're looking to make one profit on either side, one on the lay bet and one on the back bet. Now if I look on the ladder, then one trade will go on the back bet, one trade will go on the lay bet side. And because the price is not erratic, it's not moving anywhere basically, then the liquidity that you've placed, i.e. the money you've placed, those price points will gradually get eaten away. And once it gets eaten away, once your bets get taken on both sides, you will make a 1 point profit. As you can see on the micro chart, it's not moving. So if this was 5, 10, 15, 20 minutes before the start of the race, you would place a make market if it's a static line. And the idea is you'll make a 1 point tick, a 1 point profit on either side of the lay and the back bet. That's one entry point you need to look for, which is a static line on the micro chart. Now, one of the other entry points I look for is, for example, on the other videos I mentioned that we're looking at backing and laying, scalping the actual favourite, and the reason being is that the bulk of the liquidity comes on the favourite horse. It always has, it always will. So we're looking at scalping and taking advantage of this liquidity. Liquidity equals money. So people placing bets on the back bet, people placing lay bets as well for the horse to lose. So we're looking at taking advantage of both sides of the equation. Now one of the entry points I look for is on the favourite. I always look at the charts. For example, if I bring this chart in here, you will see the price started about 3.3 5, you can see that, and it's actually drifted up, it's steamed down, it's drifted up to 5, and then it's actually steamed down and it's drifted up again. Now what I look for in the favourites is that if the price has started much lower and it's actually drifted up, for example, if you look at this point here at 5.0, if this was 5-10 minutes before the start of the race, with this being the favourite, I would look at this price steaming down. And the reason I would look at that is because the last 5, 10, 20 minutes, when the majority of liquidity enters the market, when punters start to place their bet, they will do so in the majority of cases on the favourite. So if it's at the highest point it's been, there's only one direction it can go, which is down. So if people are backing this horse to win, and more people are backing this horse in the last 5-10 minutes, the price can only drop. So what we're looking at doing is taking advantage of this price drop, making money on the steam down. So it's at a high point, if you look at this chart, it's at a high point of 5 and then it's steamed down to 4. You can see that, that's one price point. So what I would have done is took advantage at this point and waited for the price to drop. As soon as the price started to drop, I will have jumped in with the back bet, and then I would have actually made the profit on the lay side once the price continued to drop. So let's say, for example, it reached a point of 5.0, which it did. As soon as it reached, say, 4.8, I will have looked at placing the back bet, and then maybe it reached 4. .6 or 4.5, then I would have placed the lay bet and I would have made the profit in between those two price points. So what we're doing is actually riding the current of the downward trend, because chances are, with it being the favourite, once it's reached the highest point and then started to turn the opposite direction, then chances are it is going to steam down. And in my experience, 9 times out of 10 that happens. And let's say it doesn't happen, let's say that 1 out of 10 chance it carries on. Let's say it starts to drop and then carries on going up. That's when you need to introduce your stop losses and see how much of a loss you're prepared to take. Because if you make 9 lots of profit and 1 set of loss, and as long as you've adhered to risk management, then you have to make a profit. It's as simple as that. So this is one of the entry points I look for, where the favourite has started lower, reached a high point, and then started to steam down. As soon as it starts to steam down, I then look at placing my back bet, which gets taken. The odds continue to steam down, and then I place the lay bet. Now if you watch the other videos on this page, you'll see I do that quite a lot, and that's probably my main strategy when scalping, and it's one I advise you to look at and practice as much as possible, because the amount of times that the favourite actually drifts up and then steams back down is a daily occurrence that happens. But if not, and let's say it's a static line for a long period of time, then you look at the make market. So really that entry point is if the price on the favourite is drifting. If it's drifting up, we look at the high point it's never been before. As soon as it starts to steam down, we then place our back bet and then we place our lay bet, and we're taking advantage of this downward steam, and that's where we make the profit. And just to give an example on this particular horse, New Agenda, even though it's late at night, there's been movement in the market. So you had a static line at 4.3, so you would have watched that. Maybe you may have placed a make market trade whilst this was happening, but as soon as the horse started and the price started to drift, you see it went from 4.3 to 4.5 and then maybe 4.6, and that reached a high point, and then it actually steamed down. So if I was trading this horse, I will have noticed this high point, and then I'd have been watching the liquidity on the lay side reducing. As soon as that liquidity on the lay side reduces, it means the price is about to steam down. And once that started to happen, I maybe would have placed the trade at 4.5. I will have placed the lay trade at maybe 4.4, and that's where I will have made the profit. So always be looking at the candle charts and always looking at the previous positions. On this candle chart, I've zoomed all the way in, so I can see it started at 4.3. So if this was 20 minutes before the race, and let's say the bulk of the activity had not started yet, the line, as you can see, is static, so this is ideal for the make market scalp. But as soon as it started to drift up, you will have noticed this on the candle chart. You will obviously notice this is the highest point it's been. So at this stage, what I would be doing and what you should be doing is watching the lay liquidity. And as soon as it starts to reduce and starts to be forced down, that's when you place your back bet. And then you're actually riding the price down. So if this, for example, 4.5 is at 4.5 there. So let's say it reached 4.4. And then it reached 4.5, and then it reached 4.6, which it did. So at 4.6 here, I will have been watching the liquidity on the lay side to reduce, which means the back bet liquidity is forcing the price down. So as soon as the money starts to reduce on the lay side, I will have placed the opposing bet on the back bet, which will have got taken. The price will have continued to drop and steam down, which it did. So maybe then at 4.4, I will have placed the lay trade, and the profit will have been made between those two price points. So that's one entry point I always look for, because the amount of time the horse drifts up and then steams back down it happens, I would say, almost every race. It just does, and you need to look for this. It's an ideal trigger point, and it's the perfect entry point. Now if, for example, you've loaded BetAngel Professional or Trader, you've loaded the software, and you've clicked on the first race of today, or the second race, or the third race, and you've loaded the candle chart, and let's say, for example, the price is in 4.4 once you're looking at the race, so you can already see that there was a static line. You can already see that the price rose to 4.6, but now it's at 4.4. What would you do then? Personally, I would wait for the price to drop to a pressure point, which is 4.3, which is where it was previously, and as soon as then it starts to rise again, I would follow the liquidity and see how far it gets. I wouldn't ride the upward trend. I know some scalpers do, but I don't, because that means you're actually having the lay bet taken first, which I think is quite dangerous in scalping. So I always try to get the back bet taken first, and the way to do that is to wait until the price has reached its high point and started to drop. So if you started the race and the price was 4.4 personally, and you can see it's been at a previous high point, I would wait until the price starts to drift up again. I would see how high it gets, and as soon as it turns the corner and starts coming back down again, that is the time I would place the back bet and then ride the steam all the way down. Now what you don't want to do in scalping is try and get too greedy. Now you can see this chart, the price actually rose to 4.6 and went back down to 4.2, for example. So you may think, well, if this is a common occurrence, why don't you place the back bet at 4.5 and then place the lay bet at 4.2? The problem with that, it's what I would call taking quite a gamble. You are taking quite a gamble there, because there's no indication that it's going to stop halfway and reverse the trend. If you're placing a scalp at 4.6 and then waiting for it to drop to 4.2, the distance between those two price points is it's a gamble. I would say that it's not gambling, but that is a gamble, and the idea is in scalping is not to get too greedy. So what I always look for, so if I'm placing the back bet at say 4.8, I won't generally go any more than 2 ticks below on the lay side. If I can take 2 ticks from every race in every race card per day, I'll be quite happy. So you need to be cautious of not getting too greedy, especially when you're starting out and you're looking for patterns. As you're starting out, I would look for a maximum of 2 ticks. Obviously on the mate market, it's going to be 1 tick either side of the current price point. But when you're looking at trends, drifting and steaming, I would keep it to a maximum of 2 ticks, especially as you're starting out. And as you gain more experience, then you can actually change the price points and maybe look for 3, 4, 5 ticks. But at this stage, I would keep it to 2 ticks. Now something else I look for, let's say for example, you put the race on, you've loaded the software, and this was the first race of the day, 1 o'clock Kempton, 7th of November. And let's say you loaded the software and the price was at 4.2. It was at the lowest point it's been. And you think, well, what do you do now? On this example, it didn't stay static. There was quite a bit of movement. If I just zoom in, you'll get a better idea of what actually happened. If you loaded the race at 4.2 and obviously it's the lowest point that price has been for that particular horse, then if there's no static market, I would wait for the price to rise. What you need in scalping and what you need in trading, you need as much control as possible. So I would wait. If the price, you'll see on some of the videos I've said I'm not going to jump in here because the price is bottomed out. And when I say bottomed out, I mean it's the lowest price point this particular horse has been, this favourite has been. So I'm not going to jump in because it could continue to steam down. And in scalping, what we're looking for is trends. We're looking for trending price points. We're looking for movement, and that's the whole basis of scalping. We're taking advantage of a moving price, and we're actually predicting the price to move and predicting the price to drop. And the way we do that is using pressure points. We look at the highest point a horse has been and the lowest point a horse has been. Once the actual price starts to turn and reverse, that's when we jump in, because then we're looking at the steam down. And the reason, again, we look at the steam down instead of the drift up, it's because we're looking at the back bet to get taken first. And one of the key reasons for that is it limits the liability. It means you actually need less money in your Betfair account to complete a scalp. Whereas if you do the lay bet first, there's obviously more liability on the lay side. For example, if you just place a direct bet on Betfair for £50 at 5.0, that's all you have to pay them if the horse loses. With laying, it works differently. You're actually liable for the whole liability, and the liability is higher than the actual stake. So if the lay bet gets taken, then the liability can be huge. So we always look for the back bet to get taken first. So that's a key reason why I always look for the downward trend rather than the upward trend. I know some scalpers do both, and they look for the upward and downward trends, but I think safety wise, working on a downward trend premise is always best, and it's safer. I feel it gives you more control. Now there's obviously many more facets to scalping than just the 2 entry points I've mentioned, but I think at this stage you need to master these 2 entry points, and if you do that, then good money can be made. Now if I click this chart, for example, there's obviously scalping in a more detailed level. There's many people who scalp who actually look for longer term gains, so they will actually place their entry point at a much earlier time scale. They'll be monitoring other horses as well, and so they may place a scalp, an entry scalp, at even 10 AM in the morning, and if there's like a 3-hour time scale before the start of the race, they're going to bank their bet on the horse either drifting or steaming. And there's methods to do this. There's methods behind that, and that's a different kind of scalping altogether. What we're looking for is short-term scalp, and long-term scalp is definitely more advanced, and it's not something I advise at this stage because it takes a lot more experience to do that. So this course is going to deal with short-term scalps, quick, easy, in and out, profits made, on to the next race. Many people who scalp the long game may only trade 2, 3, 4 races a day, and they are more experienced. I can do that. I know how to do that. But I think at this stage, you need to keep it simple. You need to look at short-term scalps. You need to get in the market, place the trades, place the opposing trades, and get out of the market with a profit. That's the majority of the scalping I do. So at this stage I would stick to those 2 entry points, and the exit points is going to be 2 ticks below where you place the back bet. Any more than that, then at this stage you are pushing your luck, and I don't advise that. So just to clarify, when I turn my BetAngel software on for the day, the first thing I do is obviously load the first race for the day. The next thing I do is check the price of where the current favourite is, and then I bring up the candle chart and I zoom in to see where the first price was. I look at the lowest point, the price point, I look at the highest price point, and then I see where the price is. Depending where the current price is, if it's halfway up the ladder, if it's halfway up the price point, then I will wait to see how high it gets, and I will only trade it when the price turns and starts to steam down. So it reaches the highest point, turns, and then comes down. And on that downward trend is when I look to make the profit. If I turn the software on and the price is at the lowest point already, I will wait and see how high it gets. If it gets halfway up and then turns, then I look at the liquidity and look at placing the back bet and the opposing lay bet. But ideally you need to wait till it reaches its highest point. Sometimes it will continue, but just watch the liquidity on the lay side, and you're watching for the liquidity to reduce. And as soon as that happens, then you place the back bet. You're going to ride the downward trend. So you place the back bet and then you place the lay bet 2 ticks below. And that's generally how you make the profit. If you place the back bet and the price reverses and starts going up again, then you need to adhere to risk management and place the stop losses. You need to see how much profit potentially you've made for the day. If you've made £10 for the day, then maybe you're going to risk £2 on a stop loss. So if you trade, let's say you traded 10 races for the day, if 8 of them continued the downward trend and you made the profit quite easily, and then 2 of them actually started a downward trend and then reversed and went against you, then you need to decide where your stop loss needs to be. So in that situation, you would actually make 8 lots of profit and 2 lots of loss. But over time, you will be able to preempt and analyze the markets in a lot more detail. You'll get familiar with how the markets are reacting to liquidity. So even though the price can go against you, experience will tell you not to jump in too quickly with the stop losses, because sometimes you need to allow the scalp and the trades, you need to allow them to breathe. A lot of traders will actually jump in too quickly and place a stop loss and get out of the market just as the price is about to go in their favor. That happens so often that many traders actually lose money. And there's a lot of people who are learning how to scalp and learning how to trade, but they are so scared of losing money that they exit the trade far too early. And that's the biggest mistake I see. But at this stage, if you're working on the downward trend situation, then that shouldn't really be a problem. If on 10 races, 2 of them or 3 of them go against you, then look at the stop loss and implement that. And even if you make a loss, then on the next trade, you can recoup that profit. Never be afraid of making a loss, but you need to control the loss. And the way to control the loss is using stop losses. So at this stage, I would focus on the make market. And if you look at this particular horse, you can see it's been fairly erratic and now it's become static again. So this would be ideal for the make market. So you're going to make a quick scalp either side of the price point, and the liquidity will gradually get eaten away and you'll make a profit. And the other entry point I would look at is once the price has reached the highest point, I would then look at placing the scalp on the downward trend. And you do that, as I've explained, by watching for the liquidity to reduce on the lay side and placing the back bet. And then 2 to 3 ticks maximum on the lay side is where you'll place the opposing trade, and that's where you can make the profit. Those 2 entry points are what I advise you focus on when you're starting, and learn and practice as much as possible and become familiar with how the markets react once more liquidity starts entering the markets in that final 5-10 minutes. And you'll see patterns and you'll see what's happening and you'll see manipulation of the markets. You'll see suddenly bulks of £5,000-10,000 enter the back bet side or the lay bet side. Now in a lot of situations that could be bookmakers offloading a risky position they have, so they'll come to Betfair. If on their bookmaker website they're taking a hit on a particular horse, they will use Betfair to actually offload some of that risk. So they'll reverse the bets which they're taking on their website, and you'll see 5, 10, even 20 grand sometimes coming in on the back bet on the lay bet side. And it can be bookmakers that you'll see on the other videos. It's what I call false liquidity. So once a bulk of cash enters the market, and let's say it's steamed down massively, you'll usually find it drifts back up because the market knows it's manipulation really, and a lot of professional traders know it's bookmakers. But also you've got traders who manipulate the market themselves, and they will come on the back bet side and the lay bet side and they'll dump a load of cash, and by doing so they actually take quite a few price points, which could be their friends. It could be their friends' money on the opposing side. So just be aware there's a lot of manipulation. But if you stick to those 2 entry points, don't get greedy, look at 2 to 3 ticks maximum, then there's a lot of money to be made. And just on those entry points alone, if you become familiar and confident, all you then need to do is scale up the stakes to make higher profit. And as I already mentioned, there's quite a few different strategies with scalping, but you don't need to learn all of them. All you need to do is become familiar and confident. It's about keeping it simple. So become familiar and confident in a few scalping examples, a few scalping techniques and then you scale up on that, and that's the way to make long-term money because you are confident in what you're doing. There's no point learning 10-20 different techniques and then having limited knowledge in all of them when you can actually master 2 to 3 techniques and then scale up once you become more confident. Okay, thank you very much. Okay, this video I actually recorded it about an hour ago and I made about £20 on this scalp. Now what I've done, I've actually recorded it and I'm going to slow it down so you can see exactly how I react to the liquidity reducing on the lay side, and this will give you a perfect pointer to what to look for yourself when you're scalping. If I can slow the video down, I've not even tested it yet, but hopefully I can slow the video down and you'll be able to see the liquidity reducing on the lay side, how I react and how I make the profit. So let's do that now. Okay, so 9th of December, 1450, 2 mile free furlong novice handicap hurdle. You can see the favourites at the highest point it's been. Check the candle chart. Highest point it's been. You can see there, it's starting its downward trend. So I'm going to try to slow certain parts of this video down so you can see. So I'm looking at the liquidity on the lay side, 8 minutes left. Liquidity on the lay side, liquidity on the back bet side. There's certain pointers I look for. You can see the second favourite there is bottomed out. So it's always interesting to know, and you need to know where the pressure is coming from. Now the fact that the second favourite's bottomed out, that's the reason why the first favourite is at the highest point it's been. So if you see there, if you follow my cursor you'll see what I'm looking for. The price is at the highest point of the short-term liquidity currently. If you look where the orange is on the first favourite, you'll see it's actually higher than where most of the bulk of the liquidity has been placed. So I'm looking at liquidity on the lay side. You can see that reducing. As soon as it reduces sufficiently, I will then place the back bet. And the reason I'm doing this now is because it's at the top end of its range, liquidity wise, you can see that, and it's at the highest point it's been. So I'm expecting its price to reduce. So where that 109 is, as soon as that starts to reduce, which it is doing, I've placed the back trade and see if that's get taken. Now I've actually slowed this video down so you can see it's working in slow motion currently. It's not taken the first time, so I may need to pull it down, but I'm quite happy to pull it down because the price range is at the top end of its short-term liquidity. So I expect it to get taken and I expect a continuation of the downward trend. So I've placed a lay trade at 3.35, so I should make £2.99 if that gets taken, which I expect it to. Okay, the price has dropped and the lay trade's been taken, and you can see on the candle chart there was a bulk of liquidity came into the market, which meant the price dropped. So we're currently at a profit of £3.03. You could see on the lay side the price started to drop, the liquidity started to reduce, and the same happened there. So I've placed a back trade, placed a lay trade, and again we've made an additional profit. So I actually slowed them videos down so you could see that. So the liquidity on the lay side started to reduce, which it did again just then. And I placed the back trade, but I actually missed it that time, so I've cancelled it. But you can see the candle chart. The downward trend happened fairly quickly and it's actually spiraling out of control. It's steaming down now. So I would expect the second favourite to be drifting up. And because that first favourite price actually spiraled down very quickly, now you look in the candle chart, about 10 grand entered the market. So what I've actually done there is placed a lay trade first, and I'm riding the trend up, I'm riding the drift up. Now these methods are not about that, but I just wanted to, I couldn't not take advantage of that. So we're looking at the downward trend rather than the upward trend, but there was a massive spike in liquidity downwards then, and the price steamed down 10 grand and entered the market, and I knew that the price was going to rebound and spiral back up, so I had to take advantage of that. But these methods are not about that. What I'm trying to show you in these videos is the reducing liquidity on the lay side, but I just had to take advantage of that, and as you can see I'm in a profit of £14. So I'm watching for the liquidity on the lay side to reduce. You can see the price has rebounded, so the price has gone back up. So it's at a fairly high point again on this favourite. So there's a possibility of another trade. So I'm watching liquidity on the pink, the lay side, and hoping it's going to reduce. And I'm expecting it to reduce because look at the candle chart, the price is at the highest point it's been. But if you look at them percentages at the top, you'll see 60-70% is on the lay side. But that's not short-term liquidity. That just indicates the whole range of liquidity on the lay side, no matter what price point that liquidity has been placed. So you can see that at 3.1 there's £15,000, 3.05, £13,000 been placed. Now these are all useful indicators. Now if this price rises to 3.4, 3.45, you can see that that will then be at the high point of its short-term liquidity. And if you check the candle chart, you can see that. So again, I'm expecting the price to drop at some stage. So I'd be watching the short-term liquidity. I'd be watching the lay price to reduce and look to ride any downward steams. So just watch. Sometimes it happens too fast and you can't get the back bet on. Now if that happens, just leave it and wait for the next opportunity, because an opportunity will always come. So this favourite is still almost at the top end of its short-term liquidity. It's almost the highest point it's been, but it started to drop. So you can see I've placed a back bet, which has now been taken, and I'll place a lay trade at 3.15. So again, that's been taken, and we're currently at £17.04 in profit. So you can see the candle chart, it actually drifted up and it steamed down, and we took advantage of that, and now it's starting to drift up again. So there's potential to make another scalp. Always be cautious of the time left. There's 1 minute 30 left before the start of this race. So what I can do now, I've made the profit, I can either decide to take this profit, it's currently £15.79, or I can take the race in play and try to make more than £15, 56 pence. So the price has absolutely reached the top end of its short-term liquidity. It's the highest price it's been. You can see there's not much money being matched at that price. This will spiral down at some stage, and it's starting to. You can see on the candle chart. So I've placed a back trade, and I'll place a secondary trade on the lay side, 2 ticks below. And there's a massive amount of liquidity coming there, £4,300. So this will reduce back down again. No doubt about it, it will rebound in the opposite direction, because it's probably bookmakers dumping a load of risky trades. So the price has started to drop, so I can now decide at which profit I can take. So just watch what happens. The race is about to start, the price has started to drop again, so I'll look to make about £19 on this one. And what I'm trying to do is show you the liquidity, how it reacts, the short-term liquidity, the highest points on the short-term liquidity. I probably would have cashed out at that £20. I'm just trying to demonstrate how it works, and I've slowed down 2 portions of this video to highlight the liquidity on the lay side dropping and how you need to react quickly. So you can see the amount of money on the short-term liquidity is quite high there. There's a lot of money being placed at 3.5. Now what's probably happened is people who have made money on the lay side have probably dumped all their liability. So they've took the profit out of the market, which means they've actually placed the cash at 3.5. That's what happened. And that's a good indication that the price is about to drop. So you can see it's dropped. I'm going to look to make the profit at £19. Let's just see. The race has gone over time, so I've placed a lay trade at 3.3. So I'm guaranteed currently £22. So if the horse wins, I'll win over £70 if I took it in play. I've took the race in play. We're currently at £23. So let's see what we can make. There's potential to make more than the original scalp, but if the horse loses, we don't lose a penny. But if the horse wins, we can make about £70 if the race concludes. Now, I'm not going to let this race conclude. I'm going to see if I can potentially make more profit than the original scalp. And I've placed a stop loss there. You can see that at 3.65. So that's the minimum I should make if the price drops back. The minimum. Now, as with traders, we don't want ideally to let the race conclude. So let's just see what we can make. There's a possibility the price can drop back, and that's the reason I've set the stop loss at 3.65. So we should make £20 if that happens. If the price reaches that, the software should kick in and it should activate that trade at 3.65, and we should make £20 and 19 pence. So let's just see what happens. The price is dropping back, as you can see. It's reaching our stop loss. It's touched our stop loss and the software has activated, so we're guaranteed now £20 and 19 pence. No matter what happens in this race, the horse can win, the horse can lose, it doesn't matter, because we've guaranteed a profit, £20 and 19 pence. So hopefully by slowing the video down, you've seen exactly where I place the trades. Now in this video, I want to discuss defensive trading. Now you've probably heard the saying that it's easy to make money gambling, it's easy to make money trading, and that's true. You could go to the race card on any given day and you could lump say £100 on the favourite of the first 3 races. And quite possibly, you may get lucky some days. You may make £500 on the first 3 races, but the subsequent races you may lose £700. So although it's easy to make the money, it's easy to lose money if you're not careful, or if you're not what I call defensive trading. Now defensive trading is quite easy to explain. Now this video, I actually recorded it earlier today because I want to pause it at certain points just to go into detail about what I'm going to explain. So I'll do that. Now just to say, for this video I have not analysed the chart, so I've not gone into detail about the credentials of the horse or any detail whatsoever. I just want to highlight certain aspects. So no matter what strategies I teach on this course, and obviously the subsequent videos go into more detail, no matter what I'm trying to teach, you need to have the basics. And you need to be able to protect the trades when they do not go in your direction. And it will happen. Historically, now we've been launched over 12 months, members have reported quite frequently that their successful trades are in the high 90% and they're making a profit. But it's quite possible to go into the 80%. As long as you're protecting what you've already made and you're in protective mode, then you can still make a fantastic profit, even if some of the trades are not going in your direction. So I'm going to try to hopefully teach that, and I'm going to pause certain sections of this video to go into detail. Now you'll notice on this race, the favourite is 1.35 currently. It's an extremely low priced favourite, and subsequent videos will explain in detail how we take advantage of that and how we make a profit from that, because it happens time and time again. Low priced favourites, there's no value. So what traders will do, they will force the price up, or they'll look for value on the second favourite or the third favourite, which means subsequently that the price of the first favourite will drift. But that's not what this video is about. So as mentioned, my own trades are in a high 95% plus success rate. There's even members from the start of the course, and even new members reporting a high 90% success rate. So what you need to do really is, on the percentage that do not go your way, and there will be some, not every trade is going to make you a profit, because if it was that easy, you wouldn't even need to learn anything. You just click and make a profit. That's not going to happen. We know that already. If you look at the screen there, you'll see where my mouse is, I've waited. Let's assume that the price was at the top of its range. It's not, because I've not analysed these charts as I mentioned. So let's assume the price was at the top of its range. And as I've already mentioned on other videos, we're then waiting for the liquidity on the lay side to reduce sufficiently. It's indicating to us that the price is going to drop 1 tick. So you can see on the back bet, the liquidity is £1,540. This has been reducing gradually. I've just paused the video. And it's currently on the lay side at £325. But that says to me the price is going to drop. So where I will place my back bet is here in this box. You see 1.34? Opposite that you'll see a blank box. So what we're doing there, we're not asking for the price at this stage, because if I click that box there, there's nobody in front of me in the queue. There's no money waiting there. So if I click that, then my trade is automatically accepted into the market. Automatically. I don't need to wait. I don't need to ask for the price. It's just taken. So what we're doing is taking advantage of the fact that the liquidity on the lay side is dropping, and we can see a gradual decrease in the liquidity. And as soon as it gets to, let's say, 20% of what it already was, then we will place a back trade, which will get accepted immediately into the market. Let's see if that happens. So it's reducing. I place the back bet straight away and it gets accepted. See, I'm in the trade. I'm not in the queue. I didn't need to ask for the price. It was just accepted. So I'll pause the video again. So the first trade's been accepted. The back bet has been taken. We're in the trade. We're in the market. And the price below 1.34, where we placed the back trade, is 1.33. You can see that, 1.33. And you can see currently £1,034 there. So where we would make the profit is by clicking that actual box, where at £1,034 is located. We will click that, and as soon as we click that, then our £2 stake will go at the back of that £1,034 and we will be sitting in the queue. Because we'll have done our homework, the price will be at the top of its range, so we're expecting this to depreciate and reduce. And as soon as it reduces, and once the queue gets to our position, where our traded money is, then we'll make the profit of 2p. Now where you can be defensive, like I said, about 90% of the time, this will go in your favour, and the price will reduce and you'll make the profit pretty quickly. But if, for example, this figure, 1,034, starts to increase, let's say it jumps to £2,000, and this figure, 713, starts to decrease, that's an indication that potentially the price is about to reverse and go in the opposite direction to where you need it to. And as you can see there, if it goes above 1.34, you're actually in a deficit. And this is where defensive trading comes into its own. Because even though the back bet's been taken at 1.34, and we're hoping it's going to reduce to 1.33, if that does not happen, and you'd be watching this figure, if that increases instead of decreases, then it's a possibility that the price is going to drift. It's going to go in the opposite direction to what we need it to. So what you can do at this stage, once this figure starts to reduce, and you're thinking, actually, it's going in the reverse direction to what I need it to, you can do what's called a scratch trade. If you place a trade now on this box here, opposite 1.34, what will have happened is that you'll have placed your existing trade at 1.34 on the back bet side. You'll now be placing an opposing bet at 1.34 on the lay side, and it will scratch itself because you can see here there's 0. So you've actually broke even at this stage, and that's what's called a scratch trade. So if, for example, 9 times out of 10, we've done our homework, we've checked the resistance points, the liquidity is reducing on the lay side, which we expect, so we place our back trade, that gets accepted. If the liquidity on the lay side does not decrease, let's say a large chunk gets taken out of that 713, and this increases to say 1734, then the trend that we've spotted originally is about to reverse. So what you need to do then is be defensive and think, that 1 out of 10 time is now happening, I need to get out. And to do that, you will click this box here. And by clicking this box, you can see there's no liquidity there. So you're not asking for a price. You're taking the current price. And by doing that, you're breaking even. So if 1 or 2 times out of 10, you have to scratch that trade and break even, then so be it. Because you'll still have 8 out of 10 trades, which did go in the right direction, which did go as anticipated, and you made the profit. And that's being defensive. So rather than thinking, well, let's just see what happens, you can be ultra defensive. I think, well, I can see immediately it's not quite going in my direction. I'm going to scratch it, wait for the next opportunity. And that's the way to do that. So you place the back bet once the liquidity is reducing. I'll just rewind that. So you can see at 1.34, I placed the back bet. Because liquidity on the lay side did reduce sufficiently, which gives me the indication because the price was at the top of its range and the liquidity was reducing, so I'm going to place that back bet, which I did. It was taken immediately. So what we need to happen now is that this figure here is going to reduce sufficiently, because what we have to do now, once we've placed our back trade, we need to place the opposing trade, and we need to do that as quickly as possible. And the reason we need to do that as quickly as possible is because there's over £1,000 in front of where we can place a trade. So if I place my £2 there now, that should go to 1,034. I'm right at the back of that queue. But because the ascendancy is on this steam, that should get eaten up pretty quickly. But if it doesn't, that's what I'm saying. If this 1032 then goes to 1,700 and the liquidity on the back bet side goes to, say, 200, that's going to tell you that the trade is not going to go as expected. So what you can quickly do is scratch that trade as fast as possible by either clicking here, which will cash you out at 0.00, and you'll be in a break-even situation. And that's being defensive. And you need to be defensive because, like I said at the start of this video, it's easy to make a profit. And it really is easy to make a profit. But you need to monitor and you need to be defensive on the trades that do not go in your direction. And as you're starting out, possibly a percentage of them early trades, you may be making an 80% success rate. And obviously the more you practice, that success rate will increase and you'll go into the 90s. But even if you get to the 95s, still being ultra cautious and ultra defensive will go in your favour because you're then removing the possibility as far as possible of making any losing trades. You will make losing trades, because what can happen is if you place your back trade here and you're then waiting for liquidity to reduce, if this increases sufficiently where it actually takes this 732 in one scoop, then the price can jump your position and then you'll be making, a loss straight away. But even so, if you're clicking out for a small loss, then it's still fine, because the profits you're going to make on the 90% of trades that do go in your favour is going to easily eclipse any losses. So that's a scratch trade, and that's being ultra defensive. And you need to practice that. You need to watch the liquidity and think, well, it's not going in my direction. I can see that 0.00 in green. That's where I can scratch it. There's a back trade and a lay trade at the same price will break even. It has to. So let's see what happens. So I've placed the back trade. I'll now place the lay trade. The only reason I'm waiting there is just to show you. And because the liquidity reduced to zero, the trade was taken straight away. But when you're trading, as soon as you've placed the back trade, you need to place the lay trade, so you're at the front of the queue. So you can see I've already made a profit. So you can see there at the top the refresh rate. You can change that. I have mine set to 500 ms, milliseconds, because my eyesight is in tune with 500 ms. Anything faster, then I can't keep up. But you may want to play around with that setting. Your eyesight may be better than mine. So you can see that I've changed it to 30 seconds, and now the liquidity entering the market is a lot slower. It's only going to change every 30 seconds, or you can change it to 1 second. So every 1 second, any liquidity that's entering the market is then updated on the ladder, as you can see. And the only reason I'm changing this is so I can explain this in detail. So you can see there the liquidity on the back bet is 2,000 plus. On the lay bet it went to 62, so I placed the back trade, which was taken immediately because I'm at the front of the queue. If there's no liquidity in the box you're ticking or clicking, then you have to go at the front of the queue. So now I'll place the lay trade at 1.33. But you'll notice that, and I'll just rewind that. So I'll place the back trade, it was accepted. Let's play this again. If the liquidity here is increasing, which it is now, I could have scratched that straight away before this liquidity entered the market. And if I'd have done that, I'd have broke even. So even though it didn't go as intended, you can get out of the trade and you can scratch it for no profit and no loss. And what we're banking on is historically, and again, now the course has been launched more than 12 months, I can see the data because figures are coming in from members and within the high 90%. So that 10% that does not make a profit, you can scratch it, or at least just go for a tiny loss and then concentrate on the net set of scalps. There's no reason why you have to, especially when you first start. You'll see I've zoomed in here. So I'll pause this right now. So you can see that 2953. Let's assume we're at the top of the range, resistance points. I'm thinking, well, I will place in this box here, I will click that, which will enter my trade. And because there's no liquidity there, I will be right bang at the front of the queue and would get accepted by the market straight away. This gets eaten up, this price drops down, and then we're working on 1.32. So as soon as we place that trade, we place the opposing trade at 1.32. Because if this gets eaten up, which we're banking on, and that's the reason why we're placing the back trade, it will jump down to 1.32. So we need to do that as fast as possible to be at as close to the front of the queue as possible. So let's see what happens. So I'm watching this figure. If this starts to increase, well, it's not, it's decreasing. But if that started to increase to say £1,500, I'd be thinking, well, it's not going in the right direction. I'm going to scratch it for the break even or a small profit. It won't be break even because I've already done some trades, so I'm in a profit already. But you can see, so I've placed the lay trade. But if this starts increasing and this decreases, let's say it goes to £200, I think, no, I need to scratch it. So I will then click this box or this box and then I'll break even. And as expected, the price did steam down and the trade was taken. So what we're doing is being defensive. We know a large portion of the trades are going to go in our direction, but it's going to be a small portion, a minority, which will go in the opposite direction. And we need to be on the lookout for that. Because the easy trades, the 90% trades, the easy money trades will be there. But the trades which reverse and don't go according to plan, we need to be ultra cautious and we need to be defensive, and that will be about 5 to 10% of the trades. Now something else I want to discuss is asking for the price or taking the price. Now you'll see here at 1.31 there's £2,002 in the queue. Above that at 1.32 there's nothing because the current price is 1.31. So, and you'll see the profit at the side here is 6 pence, 5 pence at 1.32, 6 pence at 1.31. It doesn't seem a lot at this stage, but once you increase your proficiency and you're trading at higher numbers, this could be, £60 or £55 or £50, whatever. So the difference between one tick is quite large, because if you're trading, let's say 50 scalps a week, then a difference in £5 times 50 adds up to the overall profitability per week. So currently at this stage, I could place a trade here at 1.32, and because there's no liquidity in front of me, I would be able to take that 5 pence profit straight away. It would get accepted by the market and I would be out of the trade. So that's taking the price. You're not asking, you don't need to ask for anything because there's nobody in front of you. You can take that profit straight away. At 1.31, where I've got an increase in profit potential, if I click this box here, I am then asking for the price because I'm asking to be matched at 1.31. I don't need to ask at 1.32 because there's nothing in front of me, and because the price has gone past that, then I would get accepted and my trade would get accepted straight away and I can take that profit. So sometimes the cash out symbol at the top, currently the cash out would show 5 pence. I can cash out now for 5 pence because I don't need to ask anyone's permission to take that profit. I don't need to wait for any position in the queue. If I take that 5 pence, and that's what the cash out will show. But sometimes it's worth waiting, because if the price is going in your direction and this liquidity starts to reduce, then by cashing out and taking the price at 1.32, it can cost you sometimes. But by being ultra cautious, taking the price instead of asking the price can be better sometimes, because you cash it out, you're not asking anyone's permission, you're not asking all these traders on the back bet side to match your liquidity. You don't need to ask, because by clicking this box here, you will cash out immediately. No delay, it gets accepted. If I click this box, then I'm asking for my money to be matched at 1.31 for an increase in profit. So on the back bet side, before these trades are taking place, by clicking this box as the liquidity is reducing, I'm not asking anyone's permission. I am taking that price at 1.31 no matter what happens. So if this price gets down to say 60 quid at £100, if I click this box here, my liquidity will get matched. I'm not asking, I'm not begging anybody, I'm going to take that price, and that's what we're doing. And because the momentum is on the downward steam, and we've checked all the candles and the resistance points, then we're expecting, because this is reducing, the price is being pushed down, that liquidity is going to get eaten up. So then we place our trade on the opposing side of the ladder, one tick below. But like I said, 10% or 5% of the time that won't happen. This figure will increase over this figure, which could push the price up. And if you do that, it's getting back to that break-even point. You can see here, if this actually increases on the lay side and this starts to decrease, it means the price is going to reverse potentially. And what you could do then is just cash out for the break-even, a scratch trade. So that's being ultra defensive. So once you place the back trade, and obviously we're hoping for the lay liquidity to reduce and the price to reduce and drop down. If that does not happen, you have an opportunity to break even. And it's far better to break even than to make a loss. So practice doing that. Practice being defensive. And what you'll find is that the profitable trades will come thick and fast. And that's great, that happens. We're into the 90% across the board pretty much. But that 5 to 10% where it does not happen, this is where we need to be cautious and this is where we need to act. So if the price starts to reverse, then we can scratch it by clicking this. And you can see there 0.00. So if I place my trade here, I'm not asking anybody, I'm not asking anyone's permission to scratch the trade and break even. I'm just going to do it. And that's all you need to do. You don't need to ask. So what's the numbers decreasing when you're placing the trades? If they don't decrease, then watch where your break-even position is, because that's being defensive, and you need to be defensive when you're trading, because the money you get made is the losses you need to protect against. So just to confirm, once you place the back trade, and here I've not placed it. I've placed a few trades on this already. The liquidity is reducing on the lay side because the liquidity on the back bet side is matching all the liquidity on the lay side. So this box here is where I click the mouse to place the back bet. Because there's no liquidity in front of my money, I will get maxed immediately. And then this gets consumed because the price is being pushed down. I then place my opposing trade on the lay bet side in this box here. Just watch. As you can see, it got consumed and we placed our trade on the back bet. So now on the lay side, we need to place our trade at 1.3 and then we make the profit between those ticks. Here, we're asking for the price. Here, we're taking that price. We're not asking anybody, and that's being defensive. So similar to the back bet, we placed it where there was no liquidity. If we want to scratch it, we'll do the same on the lay side. But if we want the profit, then obviously we need to go in the queue. So that's the importance of clicking as fast as possible. The alternative is to use the offset feature on BetAngel. So when you place the first trade, the opposing trade is taken straight away. So there's no delay, it's taken into the queue immediately. So by the time you've moved your mouse here, then there could be £300 added on top. The offset feature will immediately place your trade at the back of the queue instead of waiting. And like I said, by the time you've waited and pulled your mouse over, there could be £300-400 added, which means you're further at the back of the queue. So there's a video on this page about the offset feature which you need to look at as well. So taking the price where there's no liquidity, asking for the price where there is liquidity because you're going at the back of the queue. But always be mindful of the break-even position, and that's how you can protect yourself and be defensive when you're trading. Okay, thank you.